Hello, everyone. I hope everyone can hear me. Charlie, can you hear me?
Yes.
Great. This is Matt Takahashi. Thank you for joining us. This is a leadership series, and it's a complimentary professional development program sponsored by Executive Biosearch, where I host featured guests to discuss topics of interest in the life science services, tools, and molecular diagnostics domain. Today, Charlie Silver has joined me. Thank you for joining us, Charlie.
Thanks, Matt. It's a pleasure to be here with you.
Great. Really appreciate it. His topic today is scaling biotechnology into different industries, startups, and growth stage companies. And just as a brief introduction, Charlie is currently the CEO and co-founder at Ruby Bio. He co-founded Mission Bio and built the company to global scale and widespread adoption after raising over $120 million for commercialization and growth. Earlier, he led product and technology at Novalex, Agilent, and Glimmerglass Networks. And he's currently an advisor to early stage CEOs across life sciences and biotech. So without further ado, I'd like to just begin by start by asking Charlie the first question. What is the origin, vision, and mission of Ruby Bio? Charlie.
Thank you for asking that, Matt. And again, thank you very much for inviting me onto the podcast. It's a privilege to be here with you. Ruby Bio as a company really started with a vision of building a business that would make a difference in the climate change and sustainability markets. When I first thought about bringing the company together, the very first thing I did was bring in my co-founder. His name is Pavan Kambam. He's a PhD in chemical engineering, and he has spent his entire career doing nothing but scaling up our type of technology, which is a biosynthetic approach to manufacturing chemicals. And the two of us came together with the mindset that having built businesses previously and having been very familiar with product development and launch and company building, we wanted to bring all of that experience together into a company that makes a difference in climate change, recognizing that climate change is the biggest problem of our generation. It is a problem that will continue into subsequent generations. And it's something that touches really every aspect of the planet, from the people who inhabit it to the environment itself, and
Thank
so on.
Thank you very much. And so what was the origin, vision, and mission of Mission Bio?
So Mission Bio is a company that came together out of Adam Abate's lab at UCSF. Adam is one of, at least in my view, one of the premier scientist entrepreneurs in the biotool space. Started up his lab at UCSF more than a decade ago, and one of the very first technologies he built out there is a single-cell genomics platform that has incredible capability for a wide array of markets. I partnered up with him and his team to get the company spun out of UCSF. And at the time, we recognized that single cell was coming of age as a technology, and that as the market becomes more familiar with these technologies, there will be need for applications that move closer into translational and clinical medicine. So we really stood up the company with the vision of building on top of the early noise in the market space around demand for single cell technology, with a purpose-built solution for single cell that carries through into impact in the clinic and in medicine and in drug development. That was the origin of the company. That we had always had the mission of growing Mission Bio through to full scale to serve every application that single cell multiomics could serve on the market. And over time, we very successfully built into that mission, and I've been very proud of what the company has continued to do recently with very strong adoption at cancer centers, all of the leading drug development companies, and especially a very unique and differentiated and highly demanded tool set for the cell and gene therapy space.
Very good. Yes, there's been quite a bit of success there. Thank you. So, how did you activate the vision of your early stage companies?
I guess I can speak the most to Ruby Bio most recently, and as I've mentioned, this is a play into the sustainability space as a way of replacing roughly $1 trillion of petrochemicals that serve the market right now. Recognizing that just based on pure economics, these chemicals are going out of business over the coming decades. So in the early days, we came together, appreciated the problem, looked widely across markets where we could make a difference in the near term, stand up a business with a high gross margin, and then ride that gross margin through to full scale on the market. So in the early days, we came together, studied markets, learned lessons learned from the industry to figure out how we can make a difference in a way that really hadn't been delivered previously. We started by identifying the very best market, and from there, we identified the very best technology to serve that market. So it's really a market-driven play. Since then, we've continued to de-risk the business over time by applying technology to deliver products that are now in evaluation by customers. From there, as we zero in on the right applications to scale up, we are continuing to reach and build out full-scale manufacturing to serve the market early on. I would say that I tend to think about a startup company in this way, and this is a lesson that an investor that I had quite a while back coached me about early on that I think I've taken to heart. A startup company is a company that you can think of as a big company, a fully mature company that has not yet grown up. And our job as entrepreneurs and startup builders is to piece together what I think of as this multi-dimensional puzzle, piece by piece, to realize the vision of this large-scale company that has not yet grown up. So as I told the story about the early days of Ruby Bio, we think of de-risking the path to a full-scale business in order of priority for the business and in order of the largest risks. Typically, you start with team. From there, market is usually the biggest risk, and then the technology and IP to serve tend to fall out of that. And from there, you build a product. So we've really thought about it very systematically and in a very structured way to step by step build our path into a full scale company, even though we have not yet grown up. And I think some of those lessons in identifying markets and then identifying technology for the market really come to bear on any business that's starting out from scratch.
Very good. So, from founding to funding, what do you think should a founder be focused on?
Well, at the very beginning of a business, in the very early stages of founding a company, and really, I mean, all the way through to full scale, the best way I think about a business is to run it as an experiment. And this is something that really hits home with scientists and engineers, especially because this is how we do our daily work on the bench. Think of a business as de-risking your path to full scale with the minimum capital required to step by step de-risk every piece of the business. And what that means is you're constantly testing. You're always running experiments. You have a hypothesis. This might be the right market, and you test that quickly. This might be the technology, and you put together a wireframe or a minimum viable product, and you test it quickly with the lightest capital burn possible, so that by the time you get no for an answer, which is very typical, you haven't burned so much capital that you can't move on to the next one. And I really think of that as every stage of a company, you focus on whatever the next test for the business is, whether it's technology or go-to-market or sometimes even team. And what that gives you is at every stage of the company, you're diligencing the business. This is your business. You're not an investor, although you've invested in your own company. You're diligencing your business the same way an investor would. And what that means is when you come back together with investors for your next financing, you've tested all the pieces of risk that you think they're going to raise because you've already raised it. You're diligencing it the same way they have. And at that point, you've got all the answers for them. So in the very early days, you think about market and customer discovery, and that's where you want to build the minimum viable product to be able to test with customers. You might be de-risking technology and IP, or you might not if you haven't yet identified the market that you want to play in. But above all, you really want to think like an investor in terms of where they view the risks. If your view of risks are aligned with theirs, and if you've answered the right questions and then prep the next stage of the business to be able to continue answering their questions, then you're aligned with investors, number one, but you're also thinking about your path to scale in terms of the pieces that you need to de-risk, which is generally the most important piece of the business at any stage.
Right, right. So, what should a founder be thinking about at an early stage for financing, in addition to what you just described?
Well, coming back to this idea of thinking like an investor, as an entrepreneur, you are your investor, and investors will think the same way. Investors think about return and risk. And those are really the pieces that's kind of your North Star at every stage of the business. If you always think about those two things in terms of every decision you make and every de-risk milestone that you think through, and again, you're very well aligned with your investors, but you're also thinking about the right path to scale for your business. So I always encourage people to think about those two parameters, even if you're thinking a lot about technology and IP, which is very relevant in the early stages, even if you're doing customer discovery to try to figure out where this can play, what your go-to-market strategy is. Always layer on that mindset of, out of this next effort, what is the return I'm going to get? How can this turn into the return, the long run return that is a full scale business? And then what are the risks of every pieces of these? What are the bottlenecks to be able to get there? And that mindset is usually the very best mindset for any kind of financing. Operationally and tactically and logistically, financing is nothing more than sales and marketing. And it is literally sales and marketing, by the CEO and management, where you are selling and marketing your equity of the company out to this market that you're creating. Instead of selling your product, you're selling the equity of the company. What's interesting about a financing is that every deal is its own market. So if you think about it in terms of sales and marketing, you are the only one selling your stock. So there's a supply of one. And the more demand you create, meaning the more investors you talk to, and the more investors you're able to move through diligence, the more efficient the market will be. So if you've only got a market of one possible investor, you're going to have a very inefficient market. You don't know that you've hit the right clearing price. The more you add to the mix, the more you're going to feel really good that you've really tested the market. You know for sure what the market is telling you about your business, and you're much more likely to achieve the optimal clearing price. So the more you think about a financing in terms of a market, and you're marketing yourself, your company as the product, the more it kind of operationalizes that view into your financing.
Very interesting. Very good. So then, how does storytelling impact the financing at an early stage, Charlie?
Storytelling is always what financing is, right? I mean, at any stage, even for a public CEO company, when you watch quarterly earnings reports, there's a little bit of history of the last quarter, and then there's a big story to tell about the next several years of growth. The difference at an early stage is always the balance between vision and execution. And at founding stage, there's nothing else but vision. You've done nothing but found the company, which is not particularly value generating or visionary. And as you go along, there's more execution to speak to, and the vision materializes. So the art of storytelling around financing a company is really around this balance between how much of the vision you tell and how much of an execution story you tell. And the balance as you go past the founding stage, that like where you draw the line of how much vision and how much execution is really the biggest piece of the art of fundraising. The vision always tells an emotional and financial and market picture of the business at full scale. And especially at an exit, because that's what your investors care about. That's where they generate their return. But really, even beyond exit, it's years or decades in the future as this business has grown to full scale. You've got category leadership in your segment. What does that business look like? Why does it matter to the world? How does it compete? How does it keep growing? What's the picture at full scale that you're driving towards? And then the execution, really at any stage, is always telling the story of what you will definitely achieve during the next financing period that you're fundraising for. And hand in hand with that execution story is why is this the right execution to build into the vision? In other words, why is this the next milestone that de-risks the business on our path to the full scale vision? So it's always the balance between those two. In the early days, it's always tempting to tell a small vision that just gets you through to the next financing. But you don't want to sell yourself short, and really your investors don't want you to sell yourself short. They want to know what this thing looks like once it's delivered the impact, because that's really the both the emotional pull and the financial return. So on the vision side, always I wouldn't say overpromise, but tell a realistic story, and in some ways reach for overpromising. Tell the biggest story you possibly can about what this business is going to become. On execution, you have to deliver, right? So that's where the rubber meets the road. And that's where, again, I'm tempted to say under promise, but you want to be very careful about telling exactly the story that you will deliver, and why that feeds into the investor's view of the biggest risk of the business, why it de-risks it, and why by de-risking it, it accelerates your path into that full-scale vision.
Got it. Thank you. Could you share with us some examples of vision and execution storytelling?
Yeah, I'll give you a very specific example from Ruby Bio, for instance, around our next stage of financing. And this is a pretty typical way to tell the story. Our vision, at a high level, our vision is category leadership within our segment that carries with it specific revenue and gross margin fundamentals for a business. And what that means is for us, we're transforming petrochemicals over to sustainable alternatives. We've started with a market called surfactants. These are the word is a portmanteau of surface active agent, and these are chemicals that are consumed by all of us. It's a $50 billion market which powers everything we use every day in your kitchen cabinet and shower and hand soap and laundry detergent. So our vision is category leadership within this $50 billion surfactant space. And the reason for that, and this is an even bigger vision, is because we believe that $1 trillion of petrochemicals needs to be shifted over to sustainability. In fact, there's some inevitability that it has to shift to sustainability because of the economics of the way petrochemicals are headed. So our vision is category leadership in this segment. And in our case, our execution plan, this is the tactical story that we tell investors we're going to achieve between now and the next financing. Our tactical plan is to scale manufacturing and revenue to grab the first application in the market and try to drive that application towards a demonstration of product market fit, which, again, once we de-risk it to that point, that opens up the right for us to play in the next stage, which will be growth stage. So those two really go closely together. The vision is the big picture over the next several decades. We believe that the market needs a company that's of the scale of BASF or Dow, DuPont, one of the big chemical players, at full scale, providing sustainable products to the market. So our vision is that we are that company from the sustainability side, and the execution plan is the path to get there and de-risk it over the next couple of years.
Wow, that's terrific. So what does valuation mean to you as a founder, Charlie?
Valuation it's such an interesting concept because there's such emotional baggage attached to this. And you find all the time that people take valuation to be a badge of honor. And investors, of course, care about how many unicorns are in their portfolio. And that's a story of valuation. I've got this many businesses that we've carried through or supported through $1 billion or more in valuation. And it can even be a mark of shame if an entrepreneur doesn't get the valuation that maybe your peers are getting, or maybe that emotionally you would have expected. It's got a lot of baggage to it, doesn't it? I tend to think of valuation as a founder. I tend to think of valuation really very analytically in terms of what it means to my business, and I don't really think about comparing across companies or even across industries. Because fundamentally, valuation is it's a handshake that binds the CEO and investor together into alignment, into a shared vision of the vision of the business and the risk of being able to achieve it. And it's really as simple as that. I mean, the bigger the vision, the bigger the market, the bigger your play in this market, certainly the bigger valuation. The riskier it is, the lower the valuation. And that's a very simple financing story from the investor perspective. If this investment is risky, then it's going to be pricier. And that price comes out of your share as an entrepreneur, because that's where the perceived risk is for this business. So it's really as simple as that. And I think people get really hung up on numbers and comparing numbers with each other, when in fact, the comparison of the number almost doesn't matter. It's the number for your business that matters in terms of what it means to your financing, to your subsequent financings, and how all your stakeholders are going to be able to make money off this. In alignment with what I said earlier about your financing market, remember, you are a supply of one, and the demand is as much as you can build it for your financing. The bigger the financing market you've created, the more investors you talk to, and the more you've scoured the landscape of possible investors, the better you will feel that this valuation is the best possible handshake between you and your investor. And indeed, the better your investor will feel about it also. And both of you will feel very good that you've built the right handshake around vision and risk, and that story is told by the number. If you're naturally aligned with your investor, in other words, if you see eye to eye on the vision and risk, then you have the right alignment between investor and their investment, which is your company. And if the alignment is somehow forced, in other words, if you have some kind of divergence in the vision or the risk, but somehow you need this investor, or the investor insists on coming into this somehow, if it's forced by the financing into a place that the valuation might not naturally be served, then I think you have some pressure in the business that will inevitably come out down the line. But ultimately, really, valuation is a story that you and your investor tell together about how you're going to make money at this business. People also get hung up on comparing across industries, and I think it's also important to appreciate that, again, this is a story of business fundamentals. It's not an emotional story of how much my business means to me. And different industries have different fundamentals. So, we're all used to every quarter going to the Cooley report or the Wilson report to see how valuations have carried over from the prior quarter. And they break it down by industries, and there's a very specific reason for that, because every industry carries its own kind of hallmarks for the business fundamentals. And you can't compare biotechnology with life sciences. You certainly can't compare life sciences with chemicals or the tech industry. And for that reason, valuations tend to be different across industries. But I think it's very deal by deal specific. And it's just really hard to compare across companies, because really what matters is the valuation to you for your company, and how that will make money for you and for your investors and your other stakeholders.
Got it. So, comparing valuation as a founder like yourself, what does valuation mean to the business?
So once you think about it from that perspective, valuation to the business is a way of saying, how much money is everyone going to make on my cap table? How much are all the stakeholders going to make in this business? And investors need a certain return. That's always the way their fund is structured. Your advisors, your employees, and certainly the founders will make a certain return based on the valuation. And in that sense, the evaluation is what aligns, the valuation aligns all of the stakeholders together in how they make money. And the biggest lever there is your financing path. And that's why early on, you actually want to put a fair amount of thought into how you're going to finance the business to scale. Because if you're counting on a single Series A to take you to liquidity, and you end up having to raise a B, a C, and a D, then you'll get diluted down, of course, and vice versa. If it goes the other way, then some other stakeholder will be diluted down or won't make the return they need. So that's why I say it's a way of aligning all the stakeholders across the business. Now, ultimately, investors and certainly venture investors take preferred shares, and there's a reason we call that preferred. It's because they're not common. It's they come with special rights and privileges attached to them because they're taking this high risk bet on the business early on, where others inside the business are not perceived to be taking that risk. What the preferred shares mean is that investors will always make money if there is any money to be made, and there are kind of pluses and minuses to this. There are error bars to that statement, but generally, preferred shares mean that your investors will always make money if there's money on the table. Founders, because typically you've got common shares, will only make money if the milestones are properly aligned and the valuation growth comes as expected and it aligns with your financing plan and everything carries through to liquidity on the execution plan that you built. So what that means, again, investors always make money if it's there, and founders only make money if you've properly executed. What that really means is that if you're naturally aligned with your investors, you haven't forced the valuation in some way, if you execute to plan, then you're going to make money as a founder. And what that really means is that the valuation doesn't matter that much. Ultimately, the number itself doesn't matter that much. It's really the alignment with investors and alignment with financing strategy that will make money for you and your stakeholders. And to me, the way I think about that is I really don't think about valuation at all. I let the market dictate what my valuation is going to be, because whether I try to force it or not, the market is going to tell me the answer. So I like to spend my time and energy building demand for the financing, because again, that tells me that I've reached the most possible investors and hopefully gotten the right answer on what the number is. And I've achieved alignment on the proper de-risking milestones, so I'm in a good place with how the investors view the business. And I really, I think a lot about expected valuation for subsequent financings, because that's how you structure the business to make money from with your investors side by side. And that's kind of your alignment on the financing strategy. So you do need to think about that for future financings, but for the current financing, whatever I'm in the middle of, there is an answer. The market knows the answer. I don't know the answer until I go to market. So I really spend my time raising, and I don't spend my time thinking about the financing, or thinking about the valuation rather.
Okay. So what are the criteria to receive funding with various stages of the business? And maybe you could share with us a little some of that criteria at various rounds of funding.
So for every business, there's kind of a natural cycle to de-risking. And whether you call it seed or Series A, those are shifting around in this latest financing downturn. But there's always a natural cycle to de-risking. And if you're well matched to that cycle, and again, you have a business with a good vision and a solid execution plan, then you'll be able to raise money for it because it's a good investment opportunity. If you're not well matched to the cycle, that's where it gets tricky, and that's where you might be able to raise, but you might get in trouble in the next round. And directionally, the natural cycle is, again, you always start with the vision, that formation stage. Typically, in the first round, whatever you want to call that, there's some discovery effort, and that's really important because a startup is never a straight path from zero to scale. There is always some discovery. Some think of it as pivoting, but I really think of a pivot as discovering what this market needs to look like at full scale. There might be some technology research, a little bit of R&D, Usually the next round is, okay, we figured out what product to build for the market, let's build it. Usually the round after that is getting that out to market and getting some early product market fit demonstration. So that's where you get the product into customer hands, get yourself into early revenue. And then from there, the next round is usually, lining up to go to market, confirming the commercialization strategy, sales cycle, all the business metrics. And that's usually the order. After that, you plug in a bunch of money and it's scaled up. These are the criteria, and it's really the alignment within these criteria, within these stages, that aligns you with investors, and then brings the whole business together. Above all, you have to have a big vision. I've said that before, but you've got to have a big vision that carries you from here to scale. And if you have that big vision and a credible plan to reach through these financings, then investors fund it. It's really as simple as that. As an example, again, with Ruby Bio as the latest example, at formation stage, we had a big vision. The very first thing we did was crawl through markets to find the very best one to play in. From there, we identified the very best technology to build on top of. And where we're at right now at seed stage is really discovery. So we've got the product together. We are sampling product on market very widely with customers as a way of narrowing down the application space, so that in the next round, which will be the Series A, we're actually past development stage. That's actually the commercial scale-up stage for us. At that point, as we head into the next round, we know exactly who we're selling to. We have a very clear P&L that's well diligenced by the market at that point. We have a very clear pipeline that then delivers in the next financing. And as you can see, you de-risked it. So in the next round, all we have to do is scale into market based on the hypothesis that we've already confirmed in this round. So that's why I think of this as the discovery round, and then the next round is the launch round. And I know recently, as markets have turned down, Series A's are looking like seeds from an investor perspective. Everything is pulling up and valuations are going down. But whatever you call it, whether it's Series Seed or Pre-Seed or Series A, those stages are always the same, and the words almost don't matter on top of it. It's really how you stage the business.
Got it. Very good. Well, we are in a very different market, and so how have you adjusted your thinking about financing in a challenging market?
I always try to think very analytically about these things. It's not again, it's not emotional, and like it's hard to remember that when you're in the thick of things, and it's either working or it's not working with investors, and you might have to adjust. It's really hard to appreciate that emotionally. But if you don't take it personally and you kind of step back from that and see the investor's perspective, you realize it's not your fault. And it's actually not even the investor's fault. It's really the macroeconomic cycle that's driving everything. And it's no one's fault. And very analytically, it's because higher interest rates, which are resulting from the correction for inflation, and the resulting uncertainty in the equity futures markets, which is really the stock market, are increasing the cost of capital. Which drops returns. And that pushes down through investors. Equity investors will naturally take less risk, and that naturally compresses valuations. And the risk naturally pushes to you because the investor is not going to be the one to absorb the valuation. They need the return they need based on their adjustment to the risk. So again, when you think about it that way, like it's no one's fault. It's just something that you've got to work through. So what do? Well, the process is exactly the same. I don't do anything different in this kind of market condition. What it means is you've got to manage your risk more carefully. And you want to raise more runway. And everybody says this at this stage. You want to raise more because it's always trickier to raise at the next round than you would expect. That's more true now than ever before. And you want to tighten your execution plan to the point that you can absorb the valuation and get to the next milestone on the lightest burn possible. And what that does for you is the runway always mitigates your risk. So runway is always equivalent to risk to some extent. But then tightening your execution plan means build a plan that you can definitely achieve. If you've got a lot of upside milestones in there, if you've got a lot of pieces that might deliver into the business in a couple of financings from now, maybe you trim that back. You want to definitely achieve the plan and make sure you can get there with the limited capital and valuation that you've got. So you might want to focus on just one milestone instead of adding a bunch of them in. Don't try to squeeze the valuation expectations. That's another thing that I think about a lot as I'm fundraising. The market always knows the right answer. And if you try to squeeze outside what the market is expecting, doing something unnatural for the business might pull it together in this stage, but it will always come back to bite you in the next stage into a position where either you don't make money or everybody doesn't make money. So it's really those two things: manage the risk with more runway and just keep your execution plan very tight. And of course, we all know that if the business can't naturally absorb that risk that investors are now pushing onto you, then that's where non-dilutive mechanisms come in. So either adding runway through grants or industry contracts, or often strategic partnering if there's good strategic fit, because then the strategics will help absorb the risk with you.
Well, so circling back to one of the various stages of the business you described previously, how can you tell whether you have product market fit?
So product market fit means a lot of things to a lot of people. And again, I always like to think very analytically about these things and try to think about what you can measure. To me, product market fit is used. So you like to think about why we're talking about it. It's used as the gate before you put a bunch more money into the company to scale it up. And you don't want to do that until you know for sure your technology works in customers' hands. They're willing to pay you for it. You made them happy with it, and they're willing to pay you again for it. And you've been able to do that over and over again with a wide enough diversity of customers that you feel like that's representative of the market. And everything I just said just means that your product is de-risked on market. And what that means is if you plow in the growth stage money, you add another 10 or $100 million into the business, it's going to go into the business building that matters. And you're not going to have to reach back and change that and have wasted that money. So really, that's what product market fit means to me. Usually at growth stage, what that means, at least to me, analytically, is that, for the last several quarters running, you've got a history of product on market with a reasonable gross margin and repeat orders. And it's as simple as that. It's repeat business that's high quality business, which will scale the company. You always want to be testing that with customers. So early on, you always gather product market requirements. You always need to go through that phase gate development of alpha, beta, soft launch. And that way you make sure you've got the best path to product market fit before you plow a bunch more money into the business. And again, do not invest in the next stage of scale until you've tested with customers in the early stage, which is your leading indicator of product market fit, or in later stages until you've actually validated that product is fully scaled up and it works. And one of the biggest pinch points in this is you get really emotionally invested in your product, and you want it to work, even if the market is telling you otherwise. So it's difficult, it's really hard, but you have to maintain that intellectual honesty when you pull back the customer feedback, because customers are usually right. As much as we think that customers don't know the answer and the technologists know it, there's usually a lot that customers have to tell you about whether or not they will adopt it, and you need to listen to that with full honesty.
Got it. So shifting a little bit, what type of people do you hire at an early stage, and what's been important for you?
This one is dear to my heart because I firmly believe that people are the biggest value of any company anywhere. And I don't care what you're selling or what industry you're in. If you're a mining company extracting gold out of the ground, it still takes people to convert that asset into revenue. And your people are absolutely everything to you. In the early stages, I think about building the scaffold of a full-scale company. Again, thinking about a startup as a big company that hasn't yet grown up. It's like, what pieces do you need to put into place now of that big company that will carry me 2 to 3 years out to de-risk and get us to the next stage? I always like to hire for experience and agility. And what I mean is experience in this specific role, and then agility in some adjacent roles that may be needed now, or maybe just adds more depth to the role at this stage. I always like to say that by definition, a startup company has never been built before. There's no one in the world who knows how to build this company because it's never been done before. And the very best you can do is hire people with adjacent experiences who's done similar things, but especially agility because they've done that, now they're doing this, and they can do it even better than that. So as an example, we like to hire top business development that's needed for this stage. But I also like agility and experience in adjacencies like marketing, product management, people who've got some passing experience in related roles. At a venture-backed company, you always hire for the next 2 to 3 years. So you don't hire full scale, don't hire early stage. Think about the next 2 to 3 years of what you need done. And for execs especially, you want to hire the role that's matched to the stage. You don't want a full-scale big corporate R&D coming in the early stages because they'll get frustrated and bored. You need to hire the person who matches the stage. The last comment that I think is really important that people often don't appreciate, and you realize this as you build an organization to scale, it's the mid-level management that's the secret to success of any big organization. The execs make those hires, the people, the individual contributors are absolutely essential, but a really top team of mid-level management with the right business operations behind them is often the secret to success of any big company.
All right. And, in this climate right now, I'm hearing more of this, but how and when do you choose to pivot as an early stage company?
So I love this topic because you've heard me say before that I don't think of pivot so much as discovery. And once you think about staging a business that way, you realize that the pivot is natural. Like it's just the part of how you build a startup company in the early days. You expect to pivot because the purpose of the business in the early stage is discovering product, market, go-to-market strategy, and so on. You always have to have a plan in place. And this is something that people often miss in the early days. You have this big vision out there. You actually have to have a plan to get there because if you don't have a plan, then there's nothing to react to as you're pivoting. A pivot is always just a way of saying, I'm running this experiment. I'm running a market test or a product test. We're going to try it and see if it works. And we believe based on this experiment, it shows how to get to full scale. But if you don't have a plan, if you don't have a reason that this gets you from here to there, then there's nothing to react to and you don't understand what you're pivoting against. So you always need a plan in place to react to. The same way when you're running an experiment, you always have a control or some other bake-off to compare with. You always have a plan in place. And in that sense, a pivot is not really it's not a pivot per se. It's really just identifying the right path for the business. I like to say that if you're pivoting in the early stages during the discovery stage, then you're doing it right. That's what you should be doing. If you're pivoting in the later stages during growth stage, that's a sign that you've done something wrong. Perhaps you didn't do it in the early stages, or maybe you invested too hard too early before you identified that pivot point. Always need to be aligned with your investors about that. If you have an investor who thinks you're just going to execute a plan in the early stages, you probably got the wrong investor for the stage of the company. So you always need to be aligned with everybody all up and down the company about what that looks like. And this is something that's also very relevant to biotech and life sciences, where these tend to be platform kinds of businesses, and you can extract applications and products out of the platform. It's healthy to plan for multiple applications during your growth stage so you don't need to pivot. What that means is, inevitably you're going to end up with multiple product lines underneath your umbrella. And if you've got a couple of those lined up, maybe there's one that's got the first commercial push and then the next one that's in development, then you've got a kind of a quick jump to push over to if the first market is not giving you those fundamentals you need without having to go back and reinvest in the business from the beginning.
Very good. Well, maybe kind of coming to a summary point. So, what are the lessons learned that you could share with us from over 20 years of company building experience, Charlie? What are your thoughts?
Matt, I know when we talked about this early, I think you had phrased the question around biotech and life sciences experience. And I would say one of the biggest lessons I've learned, actually coming from other industries, because I started out in telecom and semiconductor, and I played in other industries early on. And I've been in biotech for about 10 years now, so I've got a nice comparison there. Biology is complex and unpredictable, right? Like everybody knows that. It's a truism. Everyone, who's ever worked in the space appreciates that. For biotech and pharma, interestingly, the biology risk is literally the investment thesis. Like that's the reason we want to invest in this company, because you've got this potentially risky thing that no one else has been able to figure out, and that is the risk we're investing in. For all other markets, and really like in any other space you would play in, that type of risk is unpredictable and completely unacceptable. Because you have to have some early starting point with some confidence that starting point de-risks your path to scale. And with biology, it's very, very difficult to do. One of my biggest lessons learned around that is for pharma and biotech, like that is the risk. It's an R&D company, and that's what you should be doing. For biotools or other markets where you're selling product to customer as a business, that type of risk is very, very challenging in the early days. And much better controlled in a research setting as opposed to a commercial setting where investors expect a quick return. Another thing that I've learned, especially from the biology markets, is, and biotech and life sciences, if you build it does not mean they will come. You always need to test market before you go build it. You always want to start with a market position, figure out why this matters to the market, figure out what the market is where this matters, and then build it. But you always need to do that with the right momentum from customers. The last few bullets here, I'm going to talk very briefly to a couple of these, but these actually come out of my very standard investor deck that I always show investors. It's actually one of the first slides in backup. And we show the title as "We hold these truths to be self-evident," because it's really like what we think about as company building in terms of what works, what we've seen work, and what really doesn't work for a startup company. And research is, I think, for academia, for government, it works really well. For full-scale corporates where you've got large R&D budgets, so you've got cash flowing through the business that invests in the next product, research makes a lot of sense. For an early stage startup, research is very, very tricky, and especially around biology, where research might not go anywhere. Research is very tricky if you're building a business on top of that. That's where, NIH, NSF, the government funding can really come in and support a business early on. But once there's investor money in the company, it really should be a development and a commercial push, but really not basic technology. Some of the other lessons we've learned is that you always build a startup on top of high margin. You can't scale a company off commodities from scratch. Always use existing manufacturing infrastructure. And that's a similar story to overhauling, a commodities market. Again, you want your innovation to be in the technology and the development, but not really in the manufacturing. We've talked about people. My biggest lesson learned ever, and this is probably my biggest takeaway overall, is focus. As a startup company, you do one thing at a time, you do it really well. You don't do a lot of things and figure out what sticks. You do one at a time, you get very good at it, and then you do the next one. Focus is the biggest lesson learned. It's also the biggest path to failure if you don't, because inevitable businesses that get too distracted can defocus, and that's where you lose sight of the goal.
Got it. I thought it might be a good time just to answer a question that came up from Tootie. For you, Charlie, the space you are entering with Ruby Bio is a hot new area with a lot of startups. How did you decide that you guys have a unique offering, niche, or what made you think that you have a distinct advantage in the market? And is that something could address now, or is that something you'd like to address to her at a different time?
No, I'd love to. It's a great question, actually, because it tells the story of how I think about building a startup company. When we started Ruby Bio, we really think about building a business. Again, we even in the early days, we don't think about a market or a technology. We think about a business and how do we get a sustainable chemicals business from here to the full scale that it deserves. And we looked at lots of markets that we could enter into. Our starting point was actually not niche. Our starting point is a giant market. So $50 billion is the surfactant market that sits underneath about $1 trillion worth of specialty chemicals. 50 billion is a large market. And we liked this one compared to a lot of others that we had worked up because it's large. It's not, just kind of a small product flip. It's a big enough market, and it's actually a fragmented enough market, which is something that I like as a startup company, because it's got room for little niche segments where we can stand up a business with the very best performance, make a difference to the market where we're the only player that can win, and then keep moving from there as we build scale. So it had a lot of this nice market dynamic of just, large scale. These products go everywhere, which is something that we like in terms of the impact. And then, the fragmented nature gives us room to plant a foothold and then move from there, or else jump from there and as I say, pivot if necessary. So it had a lot of those nice market dynamics. In addition, it's got a starting point. We're not the first player on that market. And in a category like this, I don't like being the first one because I'd much prefer to be able to see what's there, what's already shifted over to bio-based, what's working, what's not, what are the opportunities, what are the gaps, and learn from that before we start spending our own money to grab that market. So it was a lot of those dynamics around the market.
Got it. Thank you. So lastly, is there anything in your time as a founder, CEO that maybe you regret or would do over given another chance?
Matt, I do not regret. I'm not a person who regrets. No, and it's true. I really, I think of learning much more than regret. And it's something that I take with me all the time, everywhere I go. I think building a company is all about continuous learning. And, I learn from what I've done at this company, and I certainly take lessons from everything I've done over my career, but I don't regret any of it. I learn from it as much as I can, and that's what company building is all about. Some of the specific lessons are not telling a big enough story. I think that's something I've learned over the years. As a scientist or an engineer, it's very tempting to tell the story of what this technology can do for this customer, or what my next fundraising is going to do for me, or where the company is going to go. It's harder to plant yourself in the future, and not just 3 to 5 to 10 years of a venture future, but 10 to 20 to 50 years of a lasting generational kind of business, and tell a big story of what the market needs to look like. So I think that's one of the lessons that I've learned over the years. That balance of execution and vision, that's something that there really is an art to that. And I think that is something I've learned over time. It's really tempting to tell a visionary story in the later stages. It's really tempting to tell an execution story in the early stages because it's easy to do. And drawing the balance is it's something that you have to be very thoughtful about. And it's so important to the business. Not investing too early. I think that's also a very important lesson learned. Don't invest before you see product market fit coming, or you already have it. So small market tests, small product tests, before you really put the big money into the company. And I think the one I would end on that is this is the one that is dear to my heart about everything I do at startup companies. The people are always the biggest part of any company. You've always got to hire the right fit. You've always got to hire the very best people who are the fit for the business. But team and culture and people are always the most important part of any company, whether it's a startup or a full-scale corporate. The people are the ones who make the business happen.
Wow. Well, thank you very much for joining us, Charlie. Really appreciate you taking the time. We also appreciate the audience attending. And as I mentioned, this is a complimentary leadership series sponsored by Executive BioSearch, where I host featured guests to discuss topics of interest in the life science services and tools and molecular diagnostic domains. Charlie, thanks again. Everyone, see you next time.
Thank you, Matt.